Yeah, good afternoon, and thanks for having me on your show, Prashant. Exceptionally good analysis, and I think you put a very good perspective to the PSU rally. But the first thought which comes to mind is that what we saw was a kind of a one-time correction of extreme undervaluation, and that process is underway. And my sense is, looking at the current price to book on ratios which you have displayed, my current assessment is that 70-80% of this correction to mean is over and done with. So now you could expect a balanced 25% correction or a movement towards the mean, and then little bit on the upside also is possible. So depending upon your trading technique and your investment strategy, I still feel that there is some more of a trading opportunity in the PSU stocks. You could see them rally easily by 15, 20, 25% over the next quarter or so. And there's one element over here which perhaps is not considered, and that is the fact that the price to book also should see significant improvement over the next few quarters or so, because economy is doing well. So net interest income, fee-based income is going to also move up in tandem with that, and costs are going to be low because of lower credit cost per se. So it's not just the price to book multiple, but the underlying price or the book value also, I think, should do pretty well over the next quarter or two.
Okay, all right. Deepan, we are focusing on the headline index and we're worried whether or not we're going to go to 19,000 or, we're going to slip a couple of 100 points. But the mid-cap space, some of those beaten down stocks, they are bouncing back. I'm going to ask you about three stocks. I hope you give me a view on one of them. Vodafone Idea, that's the biggest gain in the last 1 hour. It's up close to on 10%. India Bulls Housing Finance, well, I think it's around a ninth of what it was at its peak. Well, that as well is up close to 7%. And RBL Bank. All those three stocks, that's Vodafone Idea, India Bulls Housing Finance, as well as RBL Bank, all three of them are flying away. View on any of these three, they have come off big time from the recent peak.
Yeah, good afternoon, Nigel. See, Vodafone Idea is like, you're buying an option. And if it survives the next 12 months or 24 months or so, then you could see the stock price going up by 50, 60% or so. But if for some reason they're not able to raise the resources and manage their debt and their outstanding, then there's a clear danger that the company may fold up. And I'm not mincing any words over here. Indiabulls Housing, I think a lot of issues around this particular stock, high degree of volatility because of management perception and whatever the past track record has been about this company. But let's face it, it is cheap. And these are good times for NBFCs, especially aggressive NBFCs like Indiabulls. And you could see a decent improvement in their earnings, and markets may start paying a higher valuation multiple as well. So again, like the PSU banks, we may see a rally in Indiabulls Housing as well. And the third company, Nigel, was
RBL Bank.
yeah, RBL Bank. Yeah, it's been a huge value destroyer. And same thing what we see in PSU banks and Indiabulls Housing can play out in RBL Bank. The real predicament here, Nigel, is that we have all these substandard banks, not so great companies with sketchy track record, have got into mess as far as NPAs are concerned, but now have finished providing for all these NPAs. And because the kind of scenario and the sector on the whole is doing well, they should be able to ride the wave. And these stocks certainly can provide a good trading rally. But when things start to get sticky, I'm not sure that you will be able to exit out of such banks or such NBFCs that easily. So one needs to be a bit careful and go with eyes wide open that there could, once the party stops in the and banks NBFC space, then these are the ones which may correct the first, because sooner or later their NPAs or some other issues may start to pop up. And when it comes to banks, in my 20 years, 30 years of analyzing them, the ones with a solid track record are the ones which deliver exceptional returns over like 5-10 year period or so. And ones with a poor track record, they do give returns to 2-3 year basis. But if you hold them for 5, 7, 10 years, then they on the whole they have underperformed the bank Nifty or the Sensex and the Nifty.
Okay, so be careful, be selective when you enter into PSU banks. The other stock, Dipan, that we want to talk about is Colgate. It's down 4.5%. Yesterday, the management met with the analysts. They've laid out their strategy for the coming year. The focus is on growth. Mangalam is here to tell us more about the brokerage commentary. Mangalam?
Well, for Colgate, it's a clear case of damned if you do and damned if you don't, because until the strategy was laid out, the brokerages were holding on to their views, hoping for the strategy to be laid out. And now that the strategy has been laid out, which to the management's credit is not too different from what they were talking about earlier, it's the execution that is important. But now the brokerages are saying that, it lacks freshness. Just to lay out the 4 points that the new MD CEO had spelled out in terms of roadmap for growth. The first one is lead toothpaste category growth by volume. Secondly, aim for premiumization through innovation as well as the scientific research that the company does. The third one, lead category growth in the toothpaste, not only the toothpaste business, but the toothbrush and devices business as well. And finally, build personal care, the Palmolive brand that they have, hand wash, face wash as well, do it via both organic as well as inorganic routes. So this was the roadmap that the company had laid out. But Citi says that, focus on both volume growth as well as premiumization together is a tall ask. It could require sustained investments with results likely to being delayed. And they will watch out for any investment that the company is doing to drive changes in consumer habits. Remember, 55% of rural consumers don't even brush once a day. Nomura too has a neutral call with a target price of 1600. So, well, the management strategy has been laid out. It's the execution that the brokerages are eyeing.
Mangalam, why don't they run ads? Brush your teeth before going to sleep. I know it's...
One-fourth of India doesn't brush its teeth in the night.
And who did the survey? So I want to know.
Yeah, go ahead, Mangalam.
So 55% of rural consumers don't brush their teeth even once a day.
Okay.
And it's only 20% of urban consumers who brush their teeth twice a day. So 80% of urban consumers also don't brush their teeth twice a day. And importantly, the average usage of toothpaste in India, if it's 1 time, the one in Philippines is 1.8 times. And for that in Brazil is 3.1 times.
Okay.
So
I'm looking for some personal help. Some convincing kids,
Oh, Asha. So maybe we should turn our attention from investor education to dental hygiene, awareness.
Absolutely. Most important.
Shocking stats, right?
Absolutely. Absolutely. Deepan, any thoughts? Colgate?
Well, I think one thing is clear that Rima is brushing her teeth twice a day. So, but it's a mature stock and a mature category. And the real issue with Colgate is the parent company does not have new categories or new products to launch into India. It's very different from Nestle or HUL. HUL goes in for acquisition. They will launch new products. They will try and get more and more innovation in the various categories they are present in. And that's how they drive that growth, and they're very aggressive about it. Nestle has it present in on the high growth categories, especially food and coffee, where there's a good runway for growth. These are the sectors where are not as much mature as say shampoos and toothpaste and soap per se. Unfortunately for Colgate, it is in a very, very mature segment of the FMCG, and there is no scope to go out of the FMCG, out of this particular category into other FMCG categories. And therefore, growth will remain pretty much slow, mid to high single digit at best for the next several years. I think there's no visibility in terms of growth going to 15-20% or so, which is the minimum benchmark that we and many investors like to look at before we even consider a stock.
Okay, all right, Deepan. Well, we thank you on that note, Deepan. We keep the hygiene high, no doubt. But thanks so much for stopping by and giving us your view on a whole host of stocks that we just discussed. By the way, my colleague Sapna is sending us some important information. The finance minister has proposed an additional 10,000 crores for railways capex over and above the 12,000 crores that was already provided in supplementary. And I think a few of these stocks should be in focus. Remember, Nimesh has done a quick update on a lot of these stocks, and they're done very well from there. So some of those rail stocks, I'm just looking at the list that he pulled out. RVNL, maybe you could focus on that because that's an infra project execution company with a focus on railways. So that one should be up for you on the screen. The other one is IRCON as well. That's done pretty well. RITES, RITES, well, that's another name. Remember, some of these stocks have done well, but more amount of money, a higher amount of focus on some of these, railway stocks and more amount of expenditure could mean good news for some of them. So just keep an eye out on that front. Sapna will keep getting you information. For the time being, though, we'll slip into a short break. On the other side, Rupal Bansali of Ariel Investments. She'll be joining in to tell us how she sees things shaping up with regard to the global markets and the approach from here on.
Welcome back. 18,650 in the Nifty, just up close to about 45 points, but we have slipped from the top of the trading session. Mid caps are going strong. The small cap index up close to about 1%. IT, metals, these are the sectors which are doing well today. Rupal Bhanshali, the Chief Investment Officer, International and Global Equities at Ariel Investments, is now with us in the studio. Rupal, it's so good to see you in person. So thank you very much for joining in.
Happy to be here.
So the first question is that you've been anti-consensus. You're writing a book about it, and you are calling for a lost decade for global equities, India included. Can you tell us what is your hypothesis?
I think valuations everywhere in the world are very high, but more importantly, profit margins, especially in the US, which accounts for 62% of the global benchmarks. So it over-indexes, in terms of its exposure, are very high. And I think a lot of people only look at the earnings multiple. I think we should also look at the debt multiple. Corporate debt has increased a lot over the last decade. And so when we look at a P multiple, it only takes market cap divided by earnings. We should look at enterprise value, which includes debt, to earnings. And we're at all-time highs for the US market, even exceeding or coming close to the levels in 2000, which everybody agrees was the last big bubble in the stock market.
But money's got to go somewhere, right, Rupal? If it's not going to go into US stocks and US assets, it'll look for yield elsewhere. And in India, since you bring up the point of debt, actually the one thing which is very clear is that Indian corporates have delevered big time, right? There's no over leverage, and there was a famous report, House of Debt, which got a lot of publicity. Highlighted the amount of debt corporates were carrying. That's not the case anymore.
Correct.
Debt-free, potential for growth. It's got to translate into growth. What's your sense about India?
I think, again, you're correct. Indian corporate balance sheets are far stronger than history. But the challenge for India is really growth. And when you have a cost of capital fixed income, you mentioned there is no alternative. TINA has now given way to TIAN, which is there is an alternative, and it's called fixed income all over the world, including in India. And I think that the cost of capital has gone up. Everybody is focused on the Fed dot plot. To me, that's a bit of a red herring, because it's not about the rate change. It's about the regime change. We're going from a world of quantitative easing to quantitative tightening. And in QE, risk-taking is rewarded. In QT, risk-taking is penalized. And equities are a high-risk asset class. And so when the risk-free rate and the risk premium goes up, it deflates valuation multiples. And so that acts as a gravitational force down. And that is true of all equities all over the world. India will be no exception.
But if you go through 10 sort of analyst reports, right, these are global economists, etc., all 10 would say that QT will become QE very soon. Interest rate hikes will become interest rate cuts. Only the timelines differ. Maybe 2023, some say 2024. So why are you saying that this is a regime change? That's not it's for 1 year. If rates go up and there is a bit of tightening, it's not a regime change, if that were to be true.
Absolutely. So you're correct. I think the consensus view is that the Fed is going to be back to its old playbook, because the moment they did the taper tantrum in 2018 and the markets fell hard in Q4 of 18, immediately the Fed pivoted and started to lower rates instead of raising them. This time is different. I know it's a very difficult thing to say, this time is different, but I will echo that. And the reason being that today, inflation expectations are getting embedded. And that is a big challenge for the Fed. It's not just about inflation in goods, which, we got good news yesterday, for example, it caused the market to go up. And I appreciate that people are calling the peak in inflation, etc. I think the real thing to watch, and this is what the Fed is watching, is wage inflation. Till that does not come down, we cannot call a victory on inflation. Until that does not come down, the Fed is not going to change its hawkish tone. Because the biggest priority for the Fed is not just bringing inflation down, it is bringing inflation expectations down. That is a psychological warfare. And you do not achieve victory there till you really test the market's resolve and conviction about this notion of a pivot. So you'll notice every time the market thinks that the Fed is going to pause or the Fed is going to do something different, they come back with a pretty hawkish tone. Now, I'm very perplexed as to why the market keeps anchoring on the Goldilocks positive side of what Powell says, but always ignores the other side of what he says. He's actually been very consistent and clear. He's acknowledged he's been behind the curve. So now he's determined he may have lost the battle, but he wants to win the war.
Hi, Rupal. It was good to meet you earlier in the newsroom. But, you're clearly sounding rather cautious, actually, on equities. But in that sort of a backdrop, going by what you're saying, QT from QE, valuations, what the Fed chair has to say, how do you position yourself? Asset allocation is going to be very, very important. So first up, how much of the money goes to equities? Within equities, what would you look at? And how much of it goes to fixed income?
So Nigel, that's a great question. I think defense is the best offense in the coming years. If the markets are going to have capital depreciation, your focus should be on capital preservation. That's the best you can do in an environment that I'm sort of expecting. And during that environment, we actually had two periods, 2 decades, which I call the lost decade. In the S&P 500, it was from 1969 to 1978, where the markets ended up lower than where they started out. The second decade where we had that similar phenomenon was between 2000 and 2010. During both of those periods, if you had invested your money in dividend-yielding stocks, they proved to be a very good way to achieve compounding of capital. And the same is true in Europe as well. So I think that same playbook applies. The amount of money that whoever feels comfortable owning equities, they should try to bias their portfolio towards dividend-yielding stocks. But the other criteria is to make sure that those companies also are either net cash or extremely well capitalized, so very low levels of debt. I think leverage is going to be a huge problem for the global economy and for the global stock markets. It's a good thing that Indian companies are not as leveraged, so it will stand them in good stead. But nonetheless, when you're looking for dividend-yielding stocks, don't be tempted by the highest dividend yields, because sometimes they can be head fake. Look for what I'm going to call the more resilient dividend yields. And frankly, we had a proof statement during COVID. Any company that could pay its dividend during COVID, chances are that dividend is pretty resilient. And again, avoid the indebted companies. Debt is going to become a 4-letter word.
Rupal, are the clients aligned with this view of yours? Because they have tasted success in the Indian equity markets. In local currency, they've made a lot of money. So are they aligned when you say that Indian markets are also, they will not be able to escape the lost decade of US and Europe?
I think a lot of investors, you're very true, especially in America, India is the darling stock market. It appeals to the sensibility of a lot of Anglo-Saxon investors, because obviously it's an English-speaking investor base and marketplace. It's also an educated one. We are a thriving democracy. I mean, all the attributes, that investors look for. The challenge, though, is markets don't care about all that. Ultimately, if real estate is about location, 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 equity markets are about earnings, earnings, earnings. And if we have a global recession next year, and it could well be a protracted and prolonged one, because we've not had a recession for a very long time. So there's a cumulative effect, that tends to show up. I think India will not be immune. So even when I talk to a lot of chief investment officers, my peers in the US, in private, they will admit to me that they think the Indian stock market is very expensive. They're still exposed to it because it's done so well. But that's the recency bias talking. I would say from a forward-looking perspective, I would be far more circumspect.
That lost decade is a scary picture to imagine, right? But my only question is, as you said, wage inflation and so the regime change. Why take a call that they will not be able to get inflation expectations under control? I mean, why should we assume that?
The reason being that COVID has somehow changed the work habits of a lot of people in societies. I think that you will see that a lot of people have left the labor market permanently. So that's a big challenge, because ultimately all of these things are about supply and demand. And in the US, we have a very red hot labor market. And frankly, if you look at even in the rest of the world, major developed countries, the labor market is quite tight, especially at the base of the pyramid.
But Rupal, everything self-corrects, right? I mean, everything in real world starts to fall back to mean, given enough time.
In the past, immigration acted as a safety valve on wage inflation. And nowadays, there's so much xenophobia in all of these countries that is no longer the safety valve. So, in the past, we took these things for granted. The other thing is demographics. Every society in the Western world is pretty much aging. And so they don't have the same amount of new cohorts of workers entering the workforce as there are leaving. So I think it's those secular forces that people are underestimating. So we've come from a wave of when labor force participation used to go up. And that was very, very beneficial, because every new person who makes money, it adds to GDP, it adds to, general wealth effects. And now the opposite is happening. So I think instead of looking at the cyclical, we need to look at the secular. And at some point, the cyclical and the secular coincide, and I think that's going to happen in the decade ahead.
I just hope it happens 5 decades out, right? Not this decade. Thank you so much, Rupal, and good luck with your book.
Non-consensus investing for sure.
Absolutely. Thank you very much.
Thank you for having me.
Thank
to
you.
our studios. We'll take a quick break here, and we'll come back. As always, we'll get you a check on what's happening in dealing rooms with Nimesh on D Street Chatter. We'll also get you some near-term trading ideas. Stay with us.
Welcome back. Well, markets are holding strong. The Nifty is up 55 points odd, but we're not seeing any kind of downtick out there. Mid-cap index continues to do an outperformance. The railway capex, well, there's going to be an additional spend out there. And we'd highlighted, RVLNL as well as IRCON, both of them could be potential beneficiaries if there's added spend that's going to come in terms of railway capex. And both those two stocks had moved up. In fact, a couple of months ago, Nimesh had alerted us that these could be a clutch of stocks that could be in focus. Clean balance sheets, big potential from here on. And let's get Nimesh in, actually. Nimesh, well, the railway stocks are moving, but it's that time of the day when you join and you tell us, what's the pulse of the dealing rooms? What are you picking up?
Nigel, before I talk about the dealing room, the railway stocks themselves are up almost double in the last 6 months,
Yes.
in the last 4 months.
4 months, yeah.
We just have to take into account that we've seen a big rally in the railway stocks. Coming to the markets, good day of trade, been consolidating with a positive bias, but I guess the momentum is clearly towards the mid cap and small cap. Even within flows, I believe for the second day running or the third day running, there is a basket buying at a leading FI day. So maybe the FI numbers will be positive again in today's trade. But that flow is largely biased towards the mid cap and small cap. That explains the mid cap index up more than 0.5%. There is a lot of momentum in the small cap stocks as well. So that's the overall feedback from the dealing rooms. I guess the FOMC event will be big thing to watch out tonight. But I guess that's pretty much in the price. So it doesn't look like there's going to be a big negative surprise, at least from the US markets. I guess within sectors, the churn continues. So within financials now, we're seeing a bit of catch up in the NBFC stocks. A lot of the NBFC stocks are buzzing in trade today and on good volumes. So that's a space to be in. Broadly, it's been a consolidation with a positive bias, but I guess the flow momentum seems to be positive and towards mid cap and small caps.
Okay, all right. Then there'll be plenty of stocks that you'll be tracking. Nimesh, run us through the list.
Okay, so in terms of individual names, the first stock is Bajaj Finance. I spoke about NBFCs doing good today, and Bajaj Finance stands out largely on back of buying interest back in that particular stock. In fact, for the last couple of days, the indication is that maybe a selling pressure from a leading FI is out of the way, and hence you're seeing a bit of buying back in that stock. So that's the first one. The second stock is VRL Logistics. We've been flashing since morning. A large block, 5.4% equity has changed hands. And in terms of activity, I believe the promoter entity was a seller, and clutch of domestic mutual funds bought into today's block. So the disclosures will be important today evening. The third is a combination of two stocks in the mid cap and small cap where you're seeing buying interest back. So LT Foods and Trident, both stocks are in focus, largely on back of buying interest at a leading FI test. We usually don't see these kind of names getting buying interest from FI, so that's why it's important. And the last combination of two stocks, Campus Activewear and Sapphire. I've been highlighting about both the stocks in the last many days. Again, the indication is that Sapphire block should come very soon, and there is an anticipation of a large block in Campus Activewear as well. For Campus Activewear, I believe it's going to be a clean out trade from a private equity, so that will be important. And for Sapphire, it's going to be a combination of an FI and a leading private equity looking to sell a large chunk in Sapphire as well.
All right, thank you very much, Nimesh. Always great getting that list of stocks, which we will keep an eye out on. Well, Mitesh is back with us. It's 3:10, and let's get the 3:10 calls out of the way. We're up 60 points on the Nifty, 18,668. Your BTST trades, Mitesh?
Yeah. Prashant, some kind of breakout is taking place on the charts of Indus Tower. So that's a BTST. Keep a stop just below levels of 198 and a target of 205 for tomorrow can be looked at. The other one which I like is from the tech space, persistent is closing near the day's high. That's a BTST as well. Keep a stop below 4180 for targets of 4235, 4240 for tomorrow.
Okay, Mitesh, thank you very much for that. Mayuresh Joshi, the head of equity research at William O'Neill, is with us on the show. Mayuresh, we were just chatting with Rupal of Ariel Investments, and she was saying when the going gets tough, it's perhaps time for your portfolio to hold a lot of dividend-yielding stocks. Is that and it's worked for global equities, whether history tells them that if you invest in dividend-yielding stocks in the US markets in the past, recessions, etc., or even in the other equity markets, it's worked. Does that work in India as well in 2023? Should one be looking at dividend-yielding stocks? And if yes, which ones?
Afternoon, Rima. So I think the arguments go both ways, right? Dividend yield stocks probably give you the comfort in terms of more payouts coming your way in case the markets go sideways. But is there capital appreciation in the underlying stock itself for the next 12 months or 18 months? Probably not, when the market probably gets very, very volatile. So yeah, I think the argument probably then goes in favor of a lot of these high yield dividend yield stocks, that they might continue their payouts in a period of uncertainty. And a lot of these dividend yield stocks actually belong, the high yielding ones belong to the government sector as well. A lot of the PSU, oil and gas space, you probably got very rich entrants even within the private space, or very few within them itself. So I think, is the underlying strong enough to probably have business momentum and therefore even appreciation happening, or stability in terms of stock prices is something that needs to be addressed. But yes, I think energy as a space generally I think is popping up onto our O'Neill sector rotation. I just tweeted about that yesterday as well. And our own belief is that that should very well continue, with a lot of government initiatives expected to come through, specifically in terms of renewables with more capital outlay. The entire perspective in terms of strong volumes growth with a lot of capacities being built over the next few quarters, translating into superior earnings growth, might very well continue with a strong underlying dividend yield as well. So I think energy as a space, within those, I think a couple of these decent dividend yield stocks, NTPC, Power Grid, might be something that long-term investors.
All right, Mayuresh, I want to speak about some companies, that's the metal stocks. You know, if there's a dovish note that's going to be coming in from the Fed, that'll be pretty good news. And that's the hope out there. So I want to ask you about them. But before that, let's focus on a couple of these names. JSPL, well, the management joined us earlier today. They confirmed that the company is purchasing Monat Power's Angul plant for around 410 crores. The company told us earlier that the Angul capacity is at around 1,050 megawatt, and it will ensure cheaper power for JSPL. You know, to discuss that, earlier today, we caught up with Mr. Jha, the managing editor of the company. Let's hear out what he had to tell us, and then Mayuresh will come across for your views.
Capacity is, as you have said, 1,050 megawatt, but it is 2 units of 525 each. It is 410 crores that we have paid for the asset purchase under NCLT. And we are going to make sure that these capacities come on stream in 2 phases. That means we will be commissioning the first turbine and then the next one over a couple of years. So that should approximately anywhere between 1,500 to 2,000 crores. It should cost the first one, because most of the things are in place. The numbers are already budgeted for in our books for, with the kind of EBITDA that we are having. We do not expect that the debt should go up, as it will be done over a period of 2 years. And as you know, that the cash flows will be funded from the business itself.
Okay, all right, Mayuresh, you heard what the management had to say. For the time being, the stock is up close to around 1.5% to around 2%. What's your view in it from here on?
So some price strength still on the O'Neill lens, Nigel, around 2% odd when it comes to the RS strength on the O'Neill methodology. But 2 things are happening here. I think on the gross debt that they're carrying on their books itself, the additional outlay that might happen with the Monat buyout, though it's coming in from internal accruals, I think that will take some element of stress on the cash flows itself. They have deleveraged their debt to a large extent. So to that extent, the impact in terms of this buyout should not be that significant in terms of more leverage occurring on the balance sheet. But I think what happens in terms of the end product prices, I think that's equally important. When you go through a lot of transcripts, you're probably getting the feeling that prices at a global level, both HRC, CRC prices, have come off quite significantly in lieu of the recessionary fears. What happens with the China unlock will be a huge trigger for these stocks going ahead as well. And input costs have definitely started going lower, whether it's coking coal, and with crude going down, I think even the logistic costs have gone down. A lot of these companies, including JSPL, has also started using a lot of captive power. And Angul's captive power is there to definitely help them going forward as that gets commissioned over the next few quarters. So yeah, I think a lot of these metal companies, steel or non-ferrous, including the likes of Hindalco, are having a very poor EPS rating at this point of time. Maybe a couple of tough quarters to probably bail them out as LME prices start moving higher. But yes, I think a couple of percentage points for JSPL to have that RS rating go up, come to the pivot, maybe some momentum onto that stock now.
Mayuresh, published at banks, time to take some profits if you are sitting on profits?
Afternoon, Prashant. I believe so. I think a couple of reasons why. One, I think the kind of run that has happened in the PSU space, specifically in the mid-cap PSU space, has been humongous over the last few weeks. I think there's a lot of missed out feeling in terms of not getting in at the right time. And therefore, I think the kind of euphoria that you're seeing for these stocks is sky high at this point of time. But elementarily, I think two things are expected to happen. One, I think the NIMs might actually peak off. Because what we're expected to see in terms of the transmissions they have done on the advances side, as the deposit rates start perking higher, you're probably expected to see NIMs consolidate in a very tight zone going forward. The second element itself is the kind of capital adequacy that a lot of these mid-cap PSU banks are carrying onto the balance sheet at this point of time. So if one intends to replicate the growth that they probably did on a low base, I think it's going to be very, very tough with lower capital adequacy, specifically Tier 1 ratios, onto their balance sheets. So NI growth will be reasonable. NIMs might be staying put in a range for some element of time. With the run-up, I think it's come close to adjusted book values for a lot of these mid-cap PSU stocks as well. And therefore, I think the entire perspective in terms of a significant run-up that has happened, I think it's away from our key pivot levels of the OD lens. Our own take is that a little bit of profit being taken off the table will do no harm. So if somebody is sitting on good profits, I think some element of profit booking is mandated, at least for these mid-cap PSU stocks.
Mayuresh, did you have a look at the Sula Vineyards IPO? Is this something someone should invest in? It's the last day to invest or subscribe to.
So, Reema, normally I think we don't comment on IPOs, but when I was going through the numbers for Sula in particular, the top line has been stagnating for the last few years. If you probably look at the margin bump up that the stock has seen, specifically in the last financial year, it's a significant bump up from the normalized margins they were posting over the last few fiscals. This is something that probably needs to be taken into account as well. Yes, I think the entire culture in terms of wines, the kind of duty structure specifically on imported wines as well, that does prove to be an advantage to Sula at this point of time. But we've hardly seen any kind of growth that probably translates into the bottom line as well. And therefore, our own sense is that with the kind of valuations that the pre-IPO price is probably asking for, there is little to be left on the table for investors who probably get into this IPO. So I think we'll wait and watch on how it opens out and wait for an IPO base as per our studies.
All right, Mayuresh, hang on. Well, before we slip into a short break, there are stocks that are moving with good amount of traction. Balrampur Chini has moved to the high point of the day, currently at more than 350 rupees. Canfin Homes as well is seeing a bit of a pullback. And the other one is Polycab. It's at 3,000 rupees odd. For this week itself, it's had a rather good week. It's up 10% for the week. So Polycab, clearly the wires and the cables division is doing quite well. KEI Industries, which is a much smaller player in comparison to Polycab, well, they said that the demand for cables is much stronger than wires, though both the segments are seeing a good amount of traction. And that explains why that stock is moving higher. Just pull up a week-to-date chart. That'll give you a better picture in terms of Polycab. Good move is what we've seen on that one. Slip into a short break, come back. We'll run you through market closing.
Okay, welcome back. Now, the finance ministers promised to stick to the fiscal glide path. She told the parliament that the government will achieve 6.4% fiscal deficit by FY23 and is on course to achieve 4.5% deficit by FY26. Also reiterating that the government is focused on inflation management. Listen in.
Fiscal deficit was estimated to reduce from 6.9% of GDP in the last year's RE to 6.4% of GDP in the current year's BE. This is very much in line with the government's commitment to achieve fiscal consolidation announced in the budget of 21-22. That is to reduce the fiscal deficit to a reasonable level till 25-26. And the current situation also very clearly gives me that kind of a feeling that we'll be able to comply with what we have said in the budget. Inflation has come and it is now come down and it is now in the tolerable band of the RBI. Inflation has been declining since April 2022 and it is declining further. CPI for November 2022 came down to 5.88% year on year, down from 6.77 in October. So I want that taken cognizance of.
That is the finance minister for you. For the markets, it's currently trading below that 18,650 marks. We're just up close to about 35 odd points. Mayurish, any thoughts on these insurance type companies, GIC, New India Assurance? They've rallied about 8 odd %. Any news that we're missing?
I'm not sure even what I have heard on that. But generally, I think the kind of premium growth that they've probably witnessed has been pretty stable so far. Whether any announcements are expected to come through for a few of them, not really sure. But not really sure behind any news behind these moves even at this point.
Okay, all right. Mayuresh, earlier this week, we spoke, or just a few days ago, we spoke to Ramkrishna Forgings. And the management, they sounded very, very confident. They were talking about revenues going to around 5,000 crores, with the current capex itself. The market seems to be liking that. There's big scope for improvement, it appears so. What's your view on the stock? It's currently up close to around 5.5%.
The momentum can very well continue, Nigel, because I think the commentary itself was very, very strong. And on the other hand, I think the non-forging business or non-classic trucks business as well, I think they're diversifying into it pretty well. So is its bigger counterpart, Bharat Forge. So I think it's going to be very, very interesting. I think the kind of numbers that get posted from the next quarter's perspective, if they do walk the talk, I think the momentum in these stocks can very well continue. But auto banks selectively are in a very, very sweet spot, Nigel, at this point of time. At Marketsbet India, obviously, we like a company called Gabriel. Very strong show in the quarter gone by. They're also getting into railways, the conversation that you were just having with Prashant. And also, I think the kind of margin profile that they've got, an expanding margin profile in an inflated input cost scenario, along with a very clean balance sheet, probably augurs well for return ratios as well. So yes, I think the momentum can continue for RK Forging and a few auto ancillary stocks like Gabriel.
Okay, Mayuresh, thank you very much for your time. Great speaking with you. Appreciate you joining in with some of that perspective. Well, the market will end with not a whimper, but not a roar either. It was up very smartly early on, did in the mid-session also was looking quite good, but would end just 38 points, 40 points higher, which is about a 0.25%, 0.2% or so. The stronger of the two parts, which is the Nifty Bank, that also did come off towards close. The high was made mid-session, 12.20 exactly, and we end at the almost at the day's lowest point for the Nifty Bank as well. So it's it's a positive close, but it's a big negative sort of daily candle on the Nifty Bank. Mid caps and small caps also came off quite a bit towards close, and 0.75% gain when we started, but they end both indices end with about a 0.5% odd gain today. Sectorally, real estate, metals, IT was higher. Perhaps the only lone loser as a sector which was down was the FMCG pack, which saw some red. Rima.
Well, the picture on the banks was mixed. So on one hand, you had Yes Bank cooling off, down 7%. Bank of India, Dhanalakshmi Bank, IDBI Bank under pressure. PNB as well, lower by 1.5%. But on the flip side, UCO Bank hits a fresh 52-week high, a 14% gain on that. This month itself, the stock has rallied close to about 68%. RBL Bank, Punjab and Sindh Bank, these were a couple of the other big movers. IOB as well, add that to the list of gainers. up nearly 5%. New India Insurance and GIC were some of the other big movers. Idea, it rallied hard on very large volumes. Volumes today are much higher, close to 5 to 6 times the daily traded turnover. Idea ends up with a gain of about 8%. On the losing side, Colgate-Palmolive slips 4%. Page Industries a bit subdued, down 3.5%. Paytm as well posts the 850 crore buyback. The stock ends lower by 1.7%. The street clearly not enthused. Nigel?
Well, that's right. You know, a few other names that did pretty well. Just take a look at the move on Suzlon. Quietly, that stock has moved up again, close to around 8% in trade today. The street clearly is reading something into it, and the delivery details as well are telling you that there is some big collection that's going on. So let's see whether or not there is some news flow and whether they can sustain. Keep in mind, it's been one of the big wealth eroders in the last 10 years or so. Moving to the other stocks that did well, housing themes did well. GIC Housing, well, that one was flying away in today's trading session. You had PNB Housing as well, that was up and about. And you had Indiabulls Housing Finance as well, that did pretty well in today's trading session. Moving to a few more gainers, PPAP Automotive from the auto ancillary names, well, that stock was up and about. Zodiac Clothing as well was up close to around 8%. Remember, some of these stocks we don't talk about very regularly, but they made it to the list because they moved up on high volumes. Finodex Industries as well was up close to around 7.5%. All in all, the mid-cap and the small-cap indices, they were really the place to be. You had big gainers out there, while for the Nifty itself, well, we ended rather subdued with a gain of close to around 35 points or thereabouts. For the time being, we'll slip into a short break. We'll see you on the other side.
Okay, the markets have closed on a fairly decent note, you know, we've got the rupee closing flashes at the bottom of the screen as well. So 82.46 as compared to 82.81 or so is where the rupee market is ending. Now, Apollo Hospitals, Sunitha Reddy talks about their flagship Indraprastha Hospital in Delhi NCR. Talking on the core hospital business, the company expects occupancies to move up to 70% with revenues generated from the oncology space to close to around 1,700 crores this year. Listen to excerpts from that exclusive conversation my colleague Ekta had earlier.
Last quarter it was at 68%, and we did have a lot of fevers also. But the important thing about Apollo is really one denominator has changed. So we have a 9% increase in operational beds. So therefore, you know, you have to keep that in mind when you look at occupancy. I think the second most important thing is that our ALOS has moved from 3.78 to 3.4. And therefore, our asset utilization and absolute number of patients have grown by 19%. So that, you know, these figures on occupancy will keep changing. But these are the levers that we use.
But any kind of guidance that you have in terms of what your target occupancy would be, where do you want it to sustain? I think it's around 70%.
Yes, you're right. It's around 70%. And I think with this level of ALOS and the current case mix we have, this is, you know, it will generate a lot of free cash flow.
But this case mix, you know, one of the views is that complex surgeries have increased quite significantly because the awareness is greater. So in terms of your case mix, is it much more complex as compared to pre-COVID?
So at Apollo, we've always focused on our COEs, Centers of Excellence, which are cardiac, orthopedic, neurology, transplants, robotic surgery, and a lot of general surgical work and mother and child. So as we look at these specialties, there has been a tremendous increase. So if you take oncology, for example, when we started our investment cycle, we were at 800 crores of revenue. Then we invested in the proton, which really no one in Southeast Asia had done. And hopefully we should close the year with 1,700 crores of revenue coming from oncology. But the premise of all this, the base of all this is that our clinical outcomes should be the best in the world. And therefore we attract the talent. And therefore we can invest in the technology.
The Proton Therapy Center, how much is it generating in terms of revenue? What is the occupancy like? Do you need to set up another center? Can we expect that?
So in terms of revenue right now, it's about 260 crores of revenue, but we're only at 50% capacity utilization. And I think, during COVID, we didn't get that many patients, but it has picked up tremendously. And I think, we can, like I said, 50% capacity utilization, which will increase because we're opening the third gantry next month.
The other big talking point post-COVID is definitely medical tourism, medical value tourism. There's so much of an impetus from the government as well on it. And companies or hospitals are looking at capex, which is catered to inflow of patients from abroad. Where does it stand as a percentage of sales? How bullish are you on it as a prospect?
People have always measured it as a percentage of sales. So we should close the year with 7%. But having said that, the absolute revenue coming from international patients has actually grown over 19% over 2020 when it was peaked. So in absolute terms, there has been an increase. And I think the potential is to go to 20% of revenue. And we believe that that Apollo will be the biggest player in international patient traffic. And I say this because of our locations. In 2 years, we'll open our Gurgaon facility. We have Delhi, Gurgaon, Bangalore, Hyderabad, Chennai, and Ahmedabad. Being located in all of these centers is bringing us patients from across the world.
Acquisitions, would you look at acquisitions just to fuel that aspect of growth? You have made smaller acquisitions, but something larger, any kind of pipeline you can share with us?
I think any acquisition that is value accretive makes sense to us. So we did Gurgaon, which is brownfield. We're setting up a hospital of the future in OMR in Chennai. So clearly we are expanding our footprint. We're adding 2,000 beds in the next 4 years. So it is a huge expansion. And acquisitions, if something comes across, something comes our way, of course we'll look at it.
Okay, well, that is a piece from a very special series we've planned for you, Medicine Box, a deep dive into the world of pharma and healthcare. Catch the full conversation this evening at 5:30 p.m. only on CNBC-TV18. Well, let's focus on the big global market cue. We are tracking the US FOMC will announce its final rate decision for this year. That's later tonight, and it is likely to hike the benchmark rates by 50 basis points. CNBC's Steve Leisman gets us highlights from the latest CNBC Fed survey on the potential rate hike and, of course, Fed funds rate outlook, the likelihood of a recession, and more. Listen.
The Fed is seen hiking 50 basis points at the meeting this week and adding another 75 next year, and causing what 2/3 of the respondents to the CNBC Fed survey believe will be a recession. But there is a small contingent, we'll look at that in a second, that's optimistic a contraction of the economy can be avoided. Here are what we call the Fed expectations. 50 this week. The new rate is going to be 4.25 to 4.5. The peak rate is seen at 5.15. That's higher than the Fed funds futures market. So this group of 34 folks think they're going to be a more aggressive Fed. The final hike comes in April, and then the Fed cruises at that speed, at that rate for 9 months. Here's the outlook from this group. 388 now goes to 438. That's between 4.25 and 4.5. 5.15 is the peak rate. And then some adjusting going on towards the end of the year, and maybe some rate cuts through 2024, ending at 380 for December 2024. Here's the recession outlook. 61% think there's going to be a recession in the next year. The average start date is in June of 2023. That is, by the way, 2 months later than the prior survey. And we've seen that in some of the Wall Street forecasts, pushing it down the road. Average length is a pretty long one, 15 months, with 67% believing it will be moderate, and about 33% think it's going to be mild. Here's the GDP outlook, and you can see 2 quarters of negative growth built in Q2 and Q3 of next year. Again, that's a quarter later for the 2 negative quarters there. But here's a little bit of optimism here. Does the Fed tighten too much, we ask, and cause a recession? That's 59%. Sorry, that's down from 71%. Is it just right? And there's that contingent of optimists right there. 24% think the Fed gets it just right. That's up from 9%. It had been higher in the past. And does the Fed tighten too little and not get inflation under control? 15% down from 20. So a little bit more optimism in there. Recession, though, remains the base case for most of the 34 respondents.
Okay, well, a 50 basis point hike is widely expected. Let's listen into what former U.S. Treasury Secretary Jack Lew and Wharton School's Jeremy Siegel make of the inflation rate situation in the U.S. Listen in.
It's going to take a while to know exactly where we are and whether or not things are settling down to a place that's going to get back to where we need to be on inflation. So I think all of the market speculation about is the Fed going to move quickly, to me, is premature. I don't think the Fed's going to change its course. I think they've signaled broadly they're going to do 50 points this week. I think they're going to hang tough until they're sure that inflation is coming down into a safe zone. And that's going to take a long time. It's not going to take a week or a month. It's going to take many months.
If the Fed stops looking at stale housing data, and I don't know why they don't, they would actually realize that inflation is, as I said a month ago, over. Now, whether they recognize that, I don't really know. I already think they're in overly restrictive territory. I think this should be the last hike. I actually think that they will see data early next year that will prompt them not to do any increases. The next discussion of the Fed is, when should we lower rates?
All right, the decision is tonight. Catch the full coverage 11 p.m. onwards only on CNBC-TV18. Let's shift focus to China and the latest on the COVID situation. China is dealing with the aftermath of its COVID policy reversal with a spike in cases and a clamor for antiviral drugs. CNBC's Sam Baddis filed this report earlier. Listen in.
Well, we're starting to see a lot of strain on the healthcare system. This was never going to be easy. China dismantling some of the toughest elements of this COVID strategy and the exit wave that could potentially produce, and certainly putting a lot of strain and overwhelming the healthcare system, which many healthcare experts over in China had said China perhaps is not ready for. We have anecdotally heard of cases very much on the rise. We've now seen that Xinhua, the state-backed news agency, has said that the situation in the capital of Beijing is particularly bad. They're saying around 50 people are now in some sort of critical condition in hospital there. We have been seeing in recent days these pictures of these long queues forming outside clinics and hospitals, people seeking fever treatment, and Beijing authorities this week saying that those looking for fever treatment had been about 16-fold from about a week ago. So we are seeing China certainly scrambling to try to meet that demand for a lot of that medicine, things like cough and cold, flu medication. What we've seen certainly underscoring the demand now is Pfizer saying it's working to provide the antiviral drug Paxlovid. This is used for treatment for mild to moderate cases with the risk of progressing to a more severe COVID. So what we're seeing is that this got the green light in China in February. Then in April, Pfizer actually signed a deal. It partnered up with a Chinese drug maker, that is a Zhejiang Huahai, to make medicine in China for patients locally. So what we're seeing now is reports that Chinese healthcare app has actually started selling the drug in what seems to be the first retail sales over in China. It's said to be going at $426 a box. People can buy the drug if they do submit a positive test, and it is reportedly been flying off the shelves. And no doubt that is a worrying sign that these cases are perhaps building, because what China is facing right now is it's wrestling with trying to ease these COVID curbs. Of course, it got rid of that ubiquitous mobile tracing app this week, with trying to keep a lid on these cases as it tries to shift from the zero COVID strategy to trying to live with the virus. And the WHO certainly acknowledging that China is going to have a tough time exiting from this zero COVID strategy. It actually drew comparisons to places like Australia, which also faced a bit of an exit wave after those restrictions were lifted. So I think it's going to be a very bumpy ride in terms of this exit, particularly as we go into the Chinese New Year and the winter months as well. And we do know that companies are very much scrambling to try to keep their operations and their businesses afloat right now.
Okay, slip into a break. Up next, we'll discuss what's buzzing in the commodity space. My colleague Manisha gets us up to date there. We're back.
आग को फैलने से रोकना मुश्किल है पर नामुमकिन नहीं। अब फायरवॉल टेक्नोलॉजी के साथ सेंचुरी प्लाई क्लब प्राइम आग से बचाए।
अरे आप इतनी दूर हमारे लिए?
आपकी मेहनत कहां से कहां पहुंच रही है। मैं आपके एक साइन के लिए यहाँ नहीं आ सकता। हो गया आपका अकाउंट ओपन।
हर बंद राह ओपन हो सकती है, लगता है सिर्फ दिल।
धन्यवाद।
एक्सिस बैंक, दिल से ओपन।
Hey Rahul, what's up?
Hey, kicked about our first date?
Of course.
Benefits up to rupees 30,000 only at the Citroën C3 Carnival. Book today.
The biggest decision makers of the Indian mutual fund ecosystem are congregating to celebrate its 36-year-long journey and deliberate the roadmap towards becoming a 100 trillion rupee industry. Witness industry's marquee leaders, CEOs and fund managers unbox the challenges and opportunities lying ahead on India's leading financial news platform. Money Control Mutual Fund Summit, targeting 100 trillion.
इस सुपरफास्ट जमाने में कार इंश्योरेंस क्लेम का स्ट्रेस क्यों? एक्को ऐप पे क्लेम सेटलमेंट सुपरफास्ट होता है।
Get super fast claim settlement. Acko, welcome change.
बड़ी खुश लग रही है। कॉन्ट्रैक्ट पे ज्यादा प्रॉफिट मिला क्या?
हाँ, कुछ मेजर हुआ क्या मार्केट में? मैं तो कानून को इंसाफ सिखा के आई हूँ। चालान कटने वाला था सिग्नल पे, सारे रूल्स फॉलो कर रही थी, पर खैर।
मैं भी वैसे ट्रेडिंग के रूल्स ही पढ़ रहा हूँ।
फिर से? वैसे मुझे भी याद नहीं है। साथ पढ़े?
आजा।
Trade only through registered members of the exchange. Insist on filling up a standard Know Your Client (KYC) form before you commence trading. Insist on getting a unique client code (UCC) and ensure all your trades are done under the said UCC. Insist on reading and signing a standard risk disclosure document. Insist on receiving the bills for every settlement.
देख, हमें तो ट्रेडिंग आती है, पर नए इन्वेस्टर को एक बार तो पढ़ ही लेना चाहिए। बाद में आसानी होती है।
Welcome back. Joining us on the show is Mr. Atul Chaturvedi. He's Executive Chairman at Sri Renuka Sugars. Mr. Chaturvedi, hi. Thank you so much for joining us. You know, I was reading the latest USDA report, and that talks about lower oilseed production for 2022-23. The number that they have put out is 644.4 million tons. How do you look at the downgrade, and is that a matter of concern?
No, in my view, the downgrade of production is only about 1 million ton.
Okay.
And million ton or about 645 million ton crop. It's no big deal.
Okay.
And my take would be this report is largely neutral.
Okay. While we are looking at a higher crop for soybean, the decline clearly seen in case of palm, cottonseed, sunflower, rapeseed, etc. Are you looking at then a price support, a consolidation, or an increase in the coming few months?
In fact, I'm more worried about the numbers which USDA has given for Argentina at around 49 point something million tons. Our information says that Argentina is actually suffering big time from drought. And one should not be surprised if the production falls dramatically. For all you know, some reports are saying that the production might actually fall to about 40 million tons or thereabouts.
Okay.
So that will be a big fall. As far as sunflower is concerned, I'm not too worried because sunflower, in any case, adequate stocks were available in Ukraine because of all the problems in terms of supply chain and disturbance and evacuation. So even a lower crop would not mean the overall availability will be affected because they are carrying a lot of stocks with them. So I don't see too much of a blip side. And secondly, with the petrol and crude oil moving southwards. So the blending might actually be affected a bit as far as palm going into blending and all. So I don't think this is, I would probably call it a neutral report.
All right, got that. So moving on, when you look at the international market, so if the supplies are going to be neutral, as you said, as much as last year, how are you looking at the demand part of it? Because for the month of October, we saw a decline at least coming in from China. The latest data shows that for the month of November as well, the Chinese soybean imports were down 14% year-on-year basis. But when you look at India, the November import shows an increase of nearly 12% on a month-on-month basis at least. How are you looking at the demand numbers stacking up for major consumers?
No, the fact of the matter is that China definitely is struggling because COVID seems to be raising its ugly head as far as China is concerned. As far as India is concerned, October, November, our demand was very strong.
Right.
But come December, we are seeing a demand petering out. In fact, we were expecting that December demand would be very, very robust, which it is not. And it also means that the heavy imports which have happened, and plus coupled with that, we have a reasonably good soya crop and cotton crop has also started hitting the markets. So all these things put together, plus the chances of rapeseed exceeding last year's production, sowing level. So rapeseed is almost 7-8% higher than last year. So all these things are putting a cap on the upside. And demand is not all that strong as far as December is concerned. October, November, it was very strong.
Okay, and I mean, how are you looking at Jan and Feb and etc. going forward? I mean, do you think that the weak demand could be a concern yet again?
Jan, I think, should bounce back.
Okay.
December, generally speaking, is normally a month when demand comes off a bit. January, February, we feel demand should come back and come back with vengeance because there are a lot of marriages both in January and February.
Yet again. All right.
Yeah.
I also want to talk about the prices because when you look at this year in the global markets, while, you know, it is only the soybean prices which show a positive trend up by 18%. Palm oil is down 12% this year. Rapeseed is down 21% this year. Sunflower is down 5.5% as well. I mean, of course, we've seen those highs and a lot of correction come into the markets, still much higher than the pre-COVID levels. But with the kind of price moves that we see, that we've seen in this year and the kind of closing that we're giving to this year, how are you looking at the new season, new year starting?
In fact, soybean lost a lot of demand because the price differential with palm had gone up as high as $450 to $500. So, but what was happening was the U.S. biodiesel mandate ensured that a lot of soybean oil got actually diverted into biodiesel big time because the biodiesel guys were making solid money, something like $500 to $600 per ton kind of money.
Okay.
The margins. So that was what was keeping the soybean oil on the boil. But now it has come off quite a bit from the high levels. In fact, the differential between palm and soya has now become much more reasonable, around $250 or thereabouts. So it has come off almost $200.
So with the kind of visibility that you have, if you were to talk about next 3 to 6 months, let's say, what kind of price moves would you expect? Are you looking at higher prices from where we are?
No, I don't think so. I don't think so. In fact, I think as far as we are concerned, we've probably seen the worst, and the worst is behind us. In fact, the prices now would probably remain more or less muted.
Okay.
And nowadays, what the price levels in India is reasonable. It's not very high. And at this level, we should have a reasonable demand. And availability and supply is absolutely no issues. Because we've imported a hell of a lot of oil as well.
All right. So enough availability and prices are expected to consolidate. So the demand perhaps should be coming back. And as said, while December didn't see much imports of edible oil into India, but Jan and Feb should come back with the vengeance. The kind of weddings and festival season that begins yet again in those couple of months. Thank you so much, Mr. Chaturvedi, for joining us. And with that, it's a wrap on Closing Bell. Thank you so much for tuning in with CNBC TV18.